Hey everyone, it's Zak Gardezy. I'm the founder of Wealthstone, a private wealth management firm in Scottsdale, Arizona, a certified financial planner, and the host of Money Minutes. So here on Money Minutes, I cover the latest market headlines and my outlook. So I've got a lot to cover this week, so let's get right into it. So to kick things off, so far, what are the impacts of the Fed's rate cuts? Last week, the Federal Reserve made a significant move by cutting interest rates by 50 basis points. Now, this shift from restrictive to a more accommodative policy is aimed at really stimulating the economy and steering us really clear of a potential recession. With the next Fed meeting not until November 6th and 7th, we have some time to see how this all plays out. So what does this mean for you? Well, the stock market has reacted positively. The S&P 500 is up over 21% now, hitting record highs. Treasury yields have dropped sharply, which is great for borrowers, but not so great for savers. High yield savings accounts and money market funds are really starting to offer lower returns. So if you've been parking cash in these accounts, it might be time to look elsewhere for better opportunities to deploy your long-term capital. Now, on a brighter note, mega cap tech stocks and the AI sector, areas that we've been focusing on at Wealthstone, have made a strong comeback in the past few weeks. With lower interest rates, these sectors are really poised to perform even better moving forward. So let's talk about what's happening in the economy. So, analyzing the housing market, the S&P Case-Shiller Home Price Index hit a new record high in July. This marks the 18th consecutive month of gains. The 20-city index saw a 0.3% month-over-month increase and a 5.9% year-over-year increase. So even after adjusting for inflation, we're still seeing some solid growth. Now, this indicates a robust housing market, which is really a cornerstone of economic strength. And then shifting gears to pending home sales. So in August, pending home sales edged up by 0.6%, and mortgage rates have dipped. I'm seeing mortgage rates below 6% at some banks. So while contract signings are still near cyclical lows, the fact that home prices continue to rise is showing us underlying demand remains strong. And then if we move on to some of the latest data on the labor market, weekly jobless claims fell by 4,000 to 218,000. This is the lowest level in 4 months. Continuing claims rose slightly, but overall, the labor market remains healthy. And corporate profits were revised higher in Q2, which bodes well for business investment and economic growth. And the manufacturing sector, through durable goods reports, it remained flat at 0.0%, which defied expectations by analysts of a 2.8% decline. This stability suggests resilience in the manufacturing sector, despite some of the various economic challenges. So all this data point towards an economy that's showing resilience and a backdrop for a soft landing scenario. This could give the Fed more confidence to continue cutting interest rates, supporting growth without risking an uptick of inflation. Now, as I mentioned last week, and I'll say again this week, there are still major risk factors to keep in mind. Let's address some of those risks here on the horizon. The U.S. political climate is one of those risk factors. The upcoming presidential election is quickly approaching, and election years often bring market volatility, really due to policy uncertainty, and it's something we need to keep an eye on. And geopolitical tensions just seem to keep escalating. This is another risk factor. In Europe, Russian President Vladimir Putin continues to make concerning statements, including threats of a nuclear response if certain red lines are crossed. Now, in the Middle East, the conflict between Israel and Hamas has escalated with recent involvement with Hezbollah in Lebanon, and the risk of a broader regional conflict involving countries such as Iran and Turkey has increased. So far, the markets really haven't reacted significantly to these tensions, but that doesn't mean we should ignore any of them. Any escalation, could impact global trade, oil prices, and lead to some increased market volatility. So it's crucial to stay informed and prepared for any of these potential disruptions. And in summary, the Fed's recent rate cuts have injected optimism into the markets, particularly benefiting sectors like tech and AI that we're closely following here at Wealthstone, and the economic data suggests that we're on solid ground. But it's important to remain vigilant given some of these geopolitical risks and the upcoming election. So as always, I'm here to help you navigate these complex times. If you have any questions or would like to discuss how these developments might affect your financial plan, please don't hesitate to reach out. Thank you for joining me on this week's episode of Money Minutes. I look forward to seeing you all again next week. Thank you.